So very good evening, friends. Let me give you a slightly different perspective. I talk about dynamic style of money management or some of our framework. I will slightly go into more details today because I think you have heard me a couple of times. Okay. So very important is that with the philosophy, how to make yourself relevant. Okay. That is the most important. So it's a picture of Ghat of Banaras, one of the oldest city in the world. Okay. Still has relevance. I've been very recently, it has changed a lot. Okay. Still very, very relevant. And there's a vibrancy out there. Okay, you can feel that vibrancy. At least I can feel it very well when you walk on the ghat and all those things. So there, when you go to certain temples, okay, or Tirupati, the energy levels are there. Okay, very different energy. And as a house, a lot of thesis we follow from our Vedic science and we try to convert into mathematical numbers and try to showcase, okay, how exactly it works. So when we talk about energy, we always say, energy doesn't die, it just changes its form, from hydro to mechanical or kinetic to potential. There's energy between us also, okay? And this exactly we bring these theses also in our analytic framework. How money shifts from high risk to lower risk environment. It never changes. When we say in the market, this much market cap got eroded. That is not a fair assessment because when you look at world as a totality, I have lost, you have gained, you have lost, and somebody else has gained. So money shift. So this entire thesis revolves around how money shift from one asset class to other, and that really helps us. I will talk about more detail in next few minutes. Okay, so let's go back. I want to talk about dynamic style of money management. You have been following a very traditional static style. We all live in a very dynamic world. Data points are changing on continuous basis. We all acknowledge that. Okay, we all understand and appreciate something has changed. But when it comes to market, you say, we are long-term investor. Nothing has changed, Okay, even there's some setback, we say we'll wait for one more quarter. We are holding for many years. And this is the perspective which we are trying to change, okay? In a dynamic world, cycles have been compressed, okay? If you don't adopt new things, okay, your relevance will be lost, okay? And we will also show you how the dynamic style generate extra alpha for you, okay? This is all about how well you generate alpha. We talk about adding alpha and subtracting beta. We are not talking about that we take more risk and hence I will deliver superior returns. It's all about with limited risk, how I'll deliver superior returns. This is something we want to talk about how dynamic style really plays us. So we are that one of the early stages of adopting on this thesis in the world. Okay, US is one country where a lot of work is happening, but India, unfortunately, we could be the pioneer in that. Okay, so just to share that, this is the success of dynamic style of money management from 27 crores 3.5 years back on the equity side. We have nearly 63,000 crores of AUM. And what is important, okay? What is very important is 63 lakhs investor base we have. We have real retail folio of 63 lakhs investor. Assuming 8-10% is duplication. That itself is a very large number. This showcases the trust at least the masses have showcased on IFAs, MFD have showcased on us. Okay, initially we used to get like 85% direct. Now 65% of incremental money comes from distributors. Okay, so that's a number which itself talks about that we are there in a smaller city without any branches, without any salesperson, pure performance, word of mouth. We are approaching there and people have understood how alpha is generated in all the categories. Okay, this is something which we want to talk about. Okay, so we have around 27 schemes out of that 24 are equity schemes. Now, this is the small journey what we have seen in last many years. Okay, this is an interesting slide. Okay, though we are a very young house, I'm talking about how dynamic style of money management works. Okay, we have been getting average 20% of the incremental flow we take up every month. We are top 5 on the incremental flows basis, on folio basis, something very last 2 years we have been doing on continuous. This is the third year in running now on the calendar year. We are in similar category. Small cap has been the largest category in terms of flow. We roughly get 35 to 40% of that number. So this level of support or trust which we have seen from investors and all our distributors people. Okay. Now I want to spend 2 minutes. Okay. Before I start my presentation, ultimately is all about result. Okay. Whether I can talk about thesis, whether it has delivered numbers or not. Ultimately, that is so this is a report card, okay? Very interesting. Quant could be the only mutual fund in all the categories which we operate. We are actually leader, okay? So it can't be a coincidence, okay? As a house, we do something right. See, mutual fund, one scheme has done well, portfolio selection was extraordinary, circumstances of that thesis or that sector did very well. But as a house, all our schemes on the top listed, okay? And this is give you perspective. This data is updated as recently yesterday. So it'll give you perspective, and we have showcased right from March 2020 itself, because as a COVID hit us, that's the low. And this is something similar time we implemented our VLRT framework. I just want to spend a minute. If you can see, all our old schemes, okay, has delivered between 300 to 800% return. Okay, that is the absolute point-to-point return which we have delivered. Look at the outperformance. Outperformance is also between some 150% to 620%. So the extraordinary outperformance is industry has not seen. People, I used to remember when we used to run our wealth company or advisory role, we have attended parties of 8%, 10% outperformance of beating the benchmark. Today, the benchmark which we have created is meaningful. Okay, this is great. So we are obviously number one in 3 years and 5 years. We are actually number one in 1 year also. What is very important is that what risk I have taken. So Jensen Alpha, Sharpe ratio, or Sortino, any risk parameter you look at mathematically, this is what we have achieved. We are across the board number one. Okay, and that gives us satisfaction. With a lot of people perceive Quant is a risky house. A lot of people perceive we are aggressive house. Numbers are different. We don't take unwarranted risk. Actually, we are a very conservative house. Okay, very proudly we say we are in the business of risk management and returns are byproduct. We don't chase returns. If you manage your risk properly, returns will come. The problem starts when you start chasing returns. Okay, and this is exactly what happened from a behavior perspective. At the peak of the cycle, you sucked in. At the bottom of the cycle, you get capitulated because it tests your patience. So we as a behavior house look at a lot of data. So we are analytic firm. We very proudly say it's analytical house. The fund management is a byproduct. This is what is our passion. So we are analytic numbers. We spend $1 million every year on analytics. We give you perspective, amount of data we subscribe. So it's a very number-centric organization. Okay. So very interesting data again. So people talk about, okay, these strategies work very well in the bull market. You are born in a bull market. Okay. So let's give you some perspective on the bull market thesis. 2020-21, yes, it was a bull market, not the beginning, but the end of the calendar year, it was a bull market. Look at the gaps which we created. Okay. So if you look at the small cap 26 versus 75%, look at 2021, great years. Now comes to 2022, difficult year. Okay, index have delivered negative return. 90% of the mutual fund scheme delivered negative return. Quant was the only house. All the schemes which we operate, all the categories, we have given positive returns and we were 10% positive return. Okay. And one of the scheme called Fundamental deliver highest nearly 28% returns. So if you really look at this, what we deliver in the difficult phase. Okay. So the dynamic style is not about we are the byproduct of the bull run. In bull market, you do very well. In the bad market, you do well. Now let's come back to even some of the schemes which we look at the NFO which we launch. Okay. The most difficult market sector has been the BFSI. Banking has underperformed. HDFC Bank, ICICI Bank, hardly deliver return quota, negative returns. Despite the sector delivered negative return or flat return marginally. Okay, from June onwards when we launch our BFSI fund, it will deliver 61% return. Okay, the outperformance is as high as some 50% or 45%. So it's a very meaningful when the sector underperformed. Sector didn't deliver. Our BFSI fund has delivered. And you look at all the category, a lot of people were worried when we launched so many thematic funds. Okay, and I explained this thesis on all the calls that we expect that between June to September 2023, risk appetite for the market should bottom out, and hence we are launching these theses that the advantage of a thematic fund is high risk, yes, but if you can time it better, you generate superior alpha out of it. And you look at all the categories which we did, all the scheme did extremely well. Look at 1 month, 2 months, 3 months, also 6 months. Despite we had, in the month of January, we have Adani episode, the public sector company suffered. If you recollect, we have unknown risk, we hit it held. Adani was not a problem. Adani exposure after the fall was only 6%. We have one of the highest exposure in public sector companies, 25%. Now you sit back, the collateral damage happened on PSUs. You sit back 1 year ahead. We are way ahead in taking a PSU call. Okay. So yes, from a risk perspective, we pruned down and right time came again, we are 25%. So it's all about how you manage your known risk as well as unknown risk. Okay. One should not get carried away with unknown risk. Okay. That is very difficult to sell. We have been a very disciplined investor. When it comes to risk management, I can tell you we can vouch for that. Our risk management capability is one of the best in the industry. Before starting the mutual fund business, I used to run the prop for 10 years. We used to do 5,000-7,000 crores of turnover every day. 10 years I ran that book. Not a single quarter was negative. Not a single year was negative. Okay. And Lehman crisis, we made 18 crore rupees in 45 days. It will give you perspective of our research capability. In a difficult phase, we made one of the highest money. Now, this is the front page of the new book which we are launching. Maybe in a month's time or 2 months' time, it should be out. Okay. So we talked about how the transition will unfold between 2017 till 2047, how world will be. One of the big theses we are talking about how relevance of leverage economy will go, and one of the reasons we don't own banking sector. Banking will not exist in this form which is there today. Our view is very different and very negative from a longer term perspective. Bank will not exist in this form the way you look at. The weightage which you have 40% or 43% will not be that number. It will be significantly low in next 3 decades. So I want to spend few minutes on some of the thesis. Timing. A lot of people believe timing is something nobody can time the market. Time in the market is very important. I agree, time in the market is very important, is your experience. But timing is a risk mitigation tool. We call it timing as an analytical tool. Okay, so we talk about time as an analytical tool. It's not about timing. Timing is the most important concept from a risk perspective. If you have not exited at time, then you are not very successful in that part. Okay. Now, the most important is like Mahabharat Chakravyuh. Okay. Why I want to talk about timing? Every big investor comes in media, talks about his timing of entry. I identify this talk. Nobody talks about mistakes. Nobody talks about failures. Okay. Limited case study about the success. Because entry, most of the people get it right. So we say entry, buying is an art and selling is a data science. Okay. Selling is more important. You have a huge emotional attachment when you can't sell the position after lot of mutual fund is still holding some of the Z and Yes banks in their portfolio because they never got exit. It's not about criticism. It's about human psyche. This is something which we have learned over a period of time. As a reason we say our VLRT framework had learned and built from mistakes. Not from that we created something unique. It's from the mistake we created these theses. So exits are very important. Okay. This is all part of some of the chapters of a new book. Okay. Now when we talk about, we always say very proudly, don't bring your subjectivity, remove these biases. The human biases has to be removed. So we talk about objective is a religion and data is God. The entire thesis revolves around analytics out here. Okay. So we bring a very mint-fresh approach for data analytics. Now, predictive analytics is the most important thesis which you want to talk about. A lot of people do post-mortem analysis, earning calls happen, people react, analysts will upgrade or downgrade. By the time event is over, okay, you have actually lost. Most of the market participants don't know up to what extent this news was factor, up to what extent this bad result was factor. It's a speculation exercise. And this is what exactly we try to do through the help of perception analytics. Okay, so perception analytics is also part of a predictive analysis. We try to, like in your kindergarten days, I always give example, your drawing book, you connect the dot and you see what picture emerges. This is the way how predictive analytics work. When we talk about multivariate models, we try to combine as much data as possible and then try to see whether I'm skewed on one side or other. Okay, so I will explain you in the VLRT framework for a minute. So important part about this is that we combine qualitative, quantitative and behavior, all three put together. It's very important. Let me give you a small example. Let's go back and understand our VLRT framework for 1 minute so you can understand and relate it better. Okay. When we talk about VLRT framework, let's understand 2 minutes. For last 8 months or 9 months, we are hearing valuations are very stretched in the market. Best of the strategies, best of the money managers, valuations are expensive. I completely agree with that. And people will give you example of 2000, what happened in 2007-8, what happened in 2017-18. Examples are perfect, but market has not fallen. Why market has not fallen? Because if you are looking at numbers in one dimensional or unidirectional approach, you don't get answer. That's the reason we bring the concept of multi-dimensional approach, and the VLRT framework has been built from the multi-dimension perspective. Okay, because when you talk about valuation, you are just looking at the valuation. What happened in 2000? The liquidity 2000 versus 2024 is few hundred times, not percentage. The liquidity parameters In 2007-8, today, we are few times of that number. Okay? Today, global equity is more than $190 trillion, which is 2 times of the global GDP. What was the risk appetite, the sentiments about India in 2007-8? People have written off. We were in a very awkward situation as a macro. Look at the currency where it was. Today, India perception is very different, very unique. And this is the mistake which happened in the market when you look at just one thing in isolation. Okay? Now something has changed. Why we have been so bullish about India? We talk about, I think Rhythm was here. He also could have given something similar thesis. Okay? We talked about, I always say I've been talking for a while, this decade belongs to us. Maybe half century belongs to us. So when you have to understand something is changing, you will be moving out of the market because you believe one thesis valuation is expensive. And trust me, best of the HNIs, best of the family office have lost this plot. Okay, it is retail who made money. I always say the retail this time is in the driving seat because retail made money in COVID time. And their M2M is so meaningful that ability to hold is there for a longer term perspective. And this is a thesis which we are explaining. The perception about India on relative basis is extraordinary. On absolute basis, our macros are good, but relative to China, relative to America, relative to Europe, maybe you can talk about few countries like Vietnam or Indonesia, we have something similar. But otherwise, most of the countries, given the size, it is very, very unique. And if you just don't look at these data points in isolation, you will not get. The other important thing, so VLRT framework give 1/3 weightage on the valuation analytics, 1/3 on risk appetite, 1/3 on liquidity. All put together, timing. Timing is a function of all three analytics. And then we drill down and try to see, like in simple terms, we talk about what drive prices, demand supply. What drive demand supply? Perception drives. If the perception is if there's shortage, perception get built, everybody is in a rush. And what drives this drive perception? Then you can drill down and try to see what. So mathematically as a house, we try to decode a lot of things. We talk about quant that's the way the word quant does not come from quantitative techniques. It comes from the background that we quantify a lot of things. Now, 2 important points also we want to talk about. It's our philosophical approach. How exactly we do? So we run multi-dimensional research, multi-asset, multi-manager, multi-variance model. What we are trying to do? We are trying to combine all the things. Who builds models? People like us build models. Then there is an analytic team who continuously update. So we don't run algos out here. We don't run high-frequency data. Yes, we use high-frequency data. But it's the calls has been taken by money manager directly. Machines are our support system. Machines are our executive assistant. They are our research assistant. Machine don't take call in quant. The money manager takes. We say analysis all add up. So we have scientists, geologists, mathematicians. We do a lot of outsource also work on the geologist side. So it's a combination, not saying how does Earth analytics affect it. It's made a lot of difference. It's been fashion now to talk about weather conditions, but nobody quantify how it affects our economy, how it affects market, how it affects sector. You have broad perspective. It is our attempt to quantify these things. So it's very important for us to understand these theses, and that's the reason we say timing is everything. It's a risk mitigation tool. Now, other important aspect I also want to talk about is that our philosophy of absolute, active, and unconstrained. Okay? When we talk about absolute return, everybody wants absolute return. Nobody wants to have, let's say 3 years are bad and you have negative return. The fund manager tell you, I outperformed. Market fell 15%, we fell only 12%. I have outperformed by 3. But you have not given him money for that negative returns. Okay? Circumstances could be there. That's the reason when we manage our money absolutely like a treasury. Okay? When we say treasury, we have a decadal view, long-term view, short-term, medium-term, hedge call, cash call, special situation, everything we try to do. The most important aspect here comes is the risk management. When you manage your short-term and medium-term risk better, not only you protect your downside, I always say you generate alpha. The small alpha, it creates a massive alpha by the end of the year or end of the quarter. And this is something which we always say, if we are a student of adaptive asset allocation, we try to adapt the environment. Let's understand, based on the weather condition, you eat your food. Based on the weather condition, you have your own attire. Okay? I cannot eat what food I enjoy to have in Punjab. If I eat in Bombay, I will be indigestion. So based on the weather, if you are in May, June sort of thing, everybody talks about monsoon distribution. Whether people criticize weather department or not, that Met department has failed. But broadly, you carry your own things. You carry umbrella, you are taking precaution because you know this is the type of weather it is. This is exactly we try to understand what type of environment it is. Is it risk on, risk off, quasi-risk on or aggressive risk on? Based on that, we rebalance our portfolio, reconstruct our portfolio. This result in high churning, with a lot of people perceive churning is bad. We have been taught a couple of wrong things in life. Churning is good. Churning helps you. So there's no concept like churning. Always is a rebalancing. We live in dynamic world. We rebalance our portfolio, and our performance talks about how well we have dynamically rebalanced our portfolio. So it's a very important aspect for us to understand. The other important aspect I talked about, why we try to remove human biases. Okay, price is the biggest bias. बोलते भाव भगवान है. Okay, people follow the trend. Okay, it's a psychological thing. When the price movement is so sharp, you get sucked in completely, and that's a time when time is there to exit. You are getting sucked in. This is what exactly we try to do in our VLRT framework, because the biggest problem of the valuation analytics, if I have to look at in isolation, is this about price. Because the 90% valuation analytics is depending on one dependent variable called price. When price change, your analytics will change. If you have not sold your technology stock in September 2021, 1.5 years later, it was down 40-50%. And exactly at the bottom of the cycle, we launched our technology fund. Best of the analysts have given up. So at September 2021, they were extraordinarily bullish. September 2023, they have all given up. And that was the bottom of the cycle. But you can feel it, we quantify it. That's the difference. When you quantify it, the answer is very different. So when third most important thing I talk about is our focus is on absolute, unconstrained. Unconstrained is a very important thing. We are style agnostic, market cap agnostic. Unconstrained, we are not constrained by any view. So if you look at, there some investors will very proudly, they say, I'm a value investor. Somebody say, I'm a growth investor. Somebody say, I'm a combination. Now a lot of factor-based models say, I'm a combination of growth and value also. Okay? Or somebody says, I'm a new age guy. New age companies, I like it. Somebody says, I'm only looking at tech company or innovation companies. Our entire thesis is pure opportunist. Wherever we see best risk-adjusted opportunity, we will try to capitalize. And this is what, if you see our numbers, from a risk-adjusted perspective, is one of the best, because we do take that calculated calls. We look at the liquidity data very closely, because a lot of people ask this question, when your size moves up, what is the answer? Okay, if you really look at when we are 40 lakhs size of the small cap in 2020, the outperformance is it. As size has grown from 2000, last 1 year, last 2 years, our performance has actually improved. The outperformance come, because this is what we have taught. That liquidities are going to be a problem for you. No, liquidity is highest at the peak of the cycle. Liquidity is highest at the bottom of the cycle. If you can exit at the peak of the cycle, this is what we measure through behavior thesis. When you see a euphoria, we demonstrated at ITC Classic, exactly at the bottom of the cycle we bought, and we sold at the peak of the cycle, 6 months back, 4 months back. From there, we built Reliance again. Reliance we bought in 2015, 2020 were the classic behavior parameters. It was the most admired territory we exited and rebuilt position in last few months. And today, how Geo Financials have done very well for us, or Reliance have done very large concentrated bet. So when we also talk about concentration, it's not about, a lot of people say extraordinary diversification mathematically is not good. On paper, it looks very nice. You can't manage. It means there is no focus in the fund. There's no conviction. We run focus fund because our conviction is high. Conviction comes from data analytics. Okay. So let's look at some of the presentation part in terms of, look at the performance aspect. I'll look at the gaps which we have created, small caps. Okay. If you've noticed in last 1 year, particularly March 2023, we were less than 5,000 or 4,000 odd crores. From 4,000, 8,000 crores, look at the performance which is there. It is very, very meaningful out here. Okay. This is the performance. When 8 became 17,000, the outperformance has actually increased. Okay. It's to give you perspective that all the schemes which we managed till today, the size has obviously grown. We are 63,000, but our outperformance continue. Look at active fund. Look at the gaps which is created. So is the case with Text Fund, which is again a leader in that category. Mid Cap Fund, another important one. Look at the gaps which is there. Flexi Cap aspect. So is the case with Infra Fund. Infra Fund has done so well even the peak of the technology boom. It has outperformed the Thematic Fund on the IT side. Okay. So it's to give you perspective. When Infra was not performing, it was outperforming the technology fund at the peak of the cycle of technology. Now obviously it is way ahead. Even liquid we are ahead, large and mid. Look at the absolute returns product. Okay. Quantamental. This was the product which done very well in 2019, 2022 also. Important thing I want to highlight out here, in all our schemes are designed in such a different manner. When you as a distributor, we have been taught everything is long term. Yes, investors are long term. Okay, asset class are long term, stocks and sectors are not long term. And hence, when we have two parameters, when we look at all the schemes have certain risk profiling and certain horizon. Okay, so let's say small and mid cap example sake are high risk but long horizon. They are long term. When you come to flexi, slightly lower risk but long term. Come to quantamental, the horizon is medium term only. Risk is low. When I say horizon is medium term, you as investors are long term. But when we manage that money, our horizon is medium term. For 2 quarters we look at. So we want to bring a lot of people in the market who are scared that market is only for long term. So if investor makes money in short term and medium term, we will convert them in long term investor where the maximum wealth is generated. How to attract that type of investor? Okay, if he is going to lose money in short term and medium term, they will never come back. So we launch Quantamental as a product for medium term perspective. Recently launched 3 months back, Momentum. Now we as a house, we are not Momentum because regulator has granted that license or the name and we took advantage of that. But for us is a short duration product. Okay. From a risk perspective, obviously more risk than Quantamental, the horizon is short. How you manage through broker or manage account portfolio. Okay. So we want to bring a lot of people who are also there from a short duration, like how you have a debt product, short duration, long duration. Similarly, we bring the concept of horizon out here. Okay. So we have long-term horizon, short-term horizon, medium-term horizon. Okay. Now you look at them, you will look at the multi-asset fund, value as a fund. Look at value fund has given extraordinary returns in last thing, and it is also topping the chart. Business cycle, again a unique product. All our thematic fund, which I want to explain you, a lot of people have this question about risk. Yes, risk in thematic will be always higher. Okay. But if you time the thematic fund, it generates extraordinary alpha and protect your downside. The most important part from our perspective, we run all our thematic fund are much more broad-based. So we will never want to launch a railway fund. It is an infra fund, a much larger. A TMT, which include technology, media, and telecom. Okay, we didn't launch a banking fund, BFSI, much larger. We didn't launch a pharma fund, a BFSI, a much larger, not FMCG, consumption fund. So all the thematic fund are much more broad-based, but we run like a flexi cap. So it's a focused flexi cap approach. Okay, focus fund obviously be more risky than the well-diversified portfolio. Similarly, this is the case even for all our thematic fund are focused flexi cap. Just trying to give you a perspective of flexi cap is well diversified, but our thematic fund are also flexi cap, but they're focused flexi cap. So approach changes. We believe as a house, we want to launch a focused strategy. I don't want to launch any product which is well diversified, 200 stock in your portfolio, 150 stock in your portfolio. All our schemes, if you look at 39% stock, we say are 80% of the portfolio. And that is the way, if you take concentrated bet, which is conviction-based, data-driven, the alpha is here. When you have 200 stocks in your portfolio, we as a risk manager cannot do it. Now, other important aspect when you talk about risk, look at Nifty. Bank Nifty is 43%, 40%. Now it is slightly down. From a risk perspective, we don't take any exposure to any sector or any group more than 20%. Okay. I have never seen in the world a 40% exposure to one particular sector is not part of any risk or proper risk management. Nobody talks about it. Nifty is a very skewed index. All outperformers in, all out underperformers are out. That's not the way indices are managed globally. Statically is wrong. And hence, we always look at 20% perspective. Okay. It makes a lot of difference. No sector exposure about 20%. Okay. Despite it being the best sector or best thing in the world. And this is a case with some momentum fund and dynamic asset. So focus fund. Still have 17 seconds left. So large cap, manufacturing. Okay. I'll stop it here. So this is the broad presentation about Quant. I'm on time.